All right. Thank you everyone for joining the call today. So my name is Kuhn Peng, and I'm currently pursuing a master's degree in management science engineering at the Stanford University, and also the vice president of Stanford Blockchain Club, and the founding director of Stanford Blockchain Accelerator Program, where we incubate crypto native projects. A fun fact: the project we incubate Avari is being acquired by Maple Finance, and Sid is we're going to talk about it. It's very interesting. That being said,
Yeah.
it's a pleasure to have Sid Powell, CEO of Maple Finance, join us today to talk about DeFi lending for institutions. That being said, I would just let Sid to give intro about himself and your journey to crypto.
Yeah, sure. And thanks for having me, Kun, and appreciate everybody joining today. So I suppose to give you a bit of background on myself and Maple. So Maple is an institutional capital marketplace. We're built on top of the Ethereum blockchain, soon to be the Solana blockchain, after the acquisition of Avari. My background was actually coming from the TradFi space. So I used to work in structured finance. And then for a time, I was running the Treasury at a commercial lending fintech. So it was actually there that I encountered the problem that we've tried to solve with Maple, which was we needed to borrow to expand that company. So it was doing loans. It needed to borrow from debt markets to continue to expand its lending business. And we were dealing with hundreds of pages of legal documents, all these third parties, be it trustees, custodians, and it was just a tremendously complex process. And the gates that growing companies need to go through to access debt capital markets today are pretty onerous. And so me and my co-founder at the time started learning about smart contracts and thinking, well, here's an obvious opportunity to replicate what our legal documents say, which is really just a whole bunch of if-then statements, if this, then that statements, using the automation that could be provided by smart contracts. And then seeing the vision that we could set up infrastructure, which would actually be globally available and allow any companies around the world to access debt capital markets. So that was really the impetus for us to tackle the problem. What we've done since then is we raised seed funding back in late 2020. So some of our backers include Polychain, Framework, Alameda, Block Tower Capital as well. We then proceeded to launch with a very small first pool of about 17 million in loans. And that was in May of 2021. And since then, we've expanded in about 8 months to having done over 550 million in loans. Now, our loans are generally targeted towards crypto native companies. So the way that Maple actually works is you kind of start with this idea or a primitive of pools. And you can think of these like an on-chain debt fund or an on-chain lending business. So from start to finish, what would happen is that the manager, so we call this person a delegate, and it would be, think of it like fixed income asset manager or a lending business that's experienced in banking and in credit, would start one of these pools on Maple, and then lenders would deposit into it. And these would be institutions, family offices, DAOs even. And then a borrower would come to the platform. Our borrowers are largely crypto native companies, and they would request a loan on chain through the manager of the pool. They go through an assessment process, and then they take out a loan on chain, manage all of their repayments. And then the cycle just continues anew. So that's a bit of an overview of how it works. One of the other really important things to note is that we have a token, and we actually use the Maple token to manage risk. And the way that that works is that it is providing a reserve, which is used to cover the potential for defaults that might occur within a pool. So anyway, that's a bit of an overview, but I'll pause there.
Thank you for the overview. We'll dive into different sections of the ecosystem and have some questions regarding each of the section. Yeah, sure. And that being said, also one of the audience know the first section will be more like the question that we prepared or collected ahead of time and prepared at that time. But even any questions, any of the points that Sid mentions, feel free to throw the question to chat or raise your hand. So the second part will unmute people from the audience, and then you can just ask the live questions. All right. That being said, the first question we have is like, what are some of the profiles of some of the lenders and the borrowers, right? Like for instance, which sectors are they in, and for the borrowers, like what are the reason like they're borrowing? What activity are they doing?
Yeah, so the way I like to conceptualize Maple is that it's in analogy a little bit similar to Shopify in that we kind of provide infrastructure to connect both borrowers and lenders in the same way that Shopify provides infrastructure for people to go and set up an e-commerce business and then serve customers, and they would compete on range, selection, price, fulfillment. We're kind of doing the same thing where we provide infrastructure on which somebody can go and set up a lending business or a fixed income asset management business, and then compete on underwriting, ability to source capital, which would mean bringing in lenders. So the typical profile of our customers are on the borrowing side, it's largely crypto native companies. So these would be market makers, market neutral trading funds. What they have in common is that they're usually they are delta neutral or delta hedged or market neutral. So this means that they're not taking risk in their trading activities of the price of crypto assets like Bitcoin or Ethereum going up or down. They should actually be neutral. What they're really providing is liquidity as a service on these exchanges and arbitraging differences in pricing either between exchange or between like assets. So all of these companies are generally quite profitable, but what they lack is access to finance through traditional means. And that's because banks largely view the space as having reputational risk, kind of akin to firearms, alcohol, or tobacco. And so that's the reason that they come to either centralized lenders, which might include like Celsius, Genesis, BlockFi, among others, or decentralized lending protocol like us. On the lending side, the profile is mostly hedge funds, VCs, family offices, or high net worths who are typically looking to get a yield on their crypto assets. And they usually have an understanding of like corporate credit markets. So that sophistication kind of allows them to, allows them to understand the credit risk that they're taking in lending to these borrowers. But they're generally what they like and appreciate about the platform is the transparency. So you can actually see who all of the borrowers are and the source of yield. And then, of course, they like the ability to really manage self-service and self-custody. So everything can be done on Maple just through the front end of our web application, which would mean, depositing, collecting your interest, collecting your MPL rewards.
Cool. Yeah, thank you for the overview of the profiles of the lender side and borrower side. So I'd like to go a little bit deeper on the, first probably the lender side. Like you said, those like hedge funds or family offices, like they really appreciate like the transparency and self-custody of your solution. But what are some of the concerns that they have, right, when you're trying to onboard them to your platform?
The typical concerns are going to be quite standard. So they're generally going to be looking at, first and foremost, they're kind of looking at credit risk because this is a lending protocol. So they'll want to know what the profile of the borrowers is, how the borrowers are underwritten. So in our case, it's the pool delegate. So the manager of that pool would meet management, understand how they do operations and security, look at their most recent financials, and make sure they actually have the ability and the capacity to repay loans. So that's the credit risk side of things. Then they'll look at smart contract risk. So they'll want to know that the protocol's been audited. And this is because you hear about other hacks or exploits which occur in the DeFi space. And so that's a very natural concern. So the tech risk. And then the other one is typically around enforcement. So because this is DeFi lending, there's a certain perception that it's like totally permissionless, and that there are actually no repercussions if a borrower defaults, which is of course not the case. So borrowers on our platform, because the loans are under collateralized or in some cases fully unsecured, they'll be signing enforceable master loan agreements, which gives a Cayman Foundation that's actually attached to the Maple DAO the ability to pursue recourse either through commencing litigation or through commencing arbitration proceedings. And so our loan contracts use the state of New York as a choice of jurisdiction there. But those are the main things that that lenders are concerned about. And of course, we try and mitigate those concerns through things like the diversification of the pool. So it's generally a portfolio of borrowers. Secondly, it's the quality of the counterparties. So we're typically only dealing on the platform with institutions that have north of 50 million in balance sheet size, and usually it's between 300 and 600 million. And then, of course, you also have that structural protection, which is the pool cover. So this means that if a borrower defaults, the pool cover can be burned to bring back USDC into the pool, which would cover the shortfall from any default. And that provides coverage up to a certain level. So it's not going to protect the whole pool if all borrowers default, but it does provide a good measure of protection for lenders.
Yep, makes sense. Thank you for explaining all the concerns, and great that you have some of the mitigation measures to address their concerns.
Yeah.
Then now, like, I would like to jump to the other side, which is like the borrower side. So you said like right now the borrower is more like crypto native, like research. So compared to other kind of existing solution like centralized CeFi solution like Celsius network or some other solutions, what is the main benefits of using like your platform?
Yeah, well, I would say like the borrowers for now are crypto native, but our approach there was we wanted to target the customer segment or the wedge that actually had the greatest need for this. So to our thinking, that was the best risk profile for that was the crypto native market makers, who are pretty profitable. They hold the assets that they borrow on their balance sheet at all times, and then just trade them on centralized exchanges. But then we want to expand concentrically out from there, which would include other crypto native type companies, but in a different sector, like maybe miners. And then beyond that, potentially SaaS or fintech companies, which would be the next, concentric circle outside of crypto natives. And then beyond that, you start to progress to kind of the broader corporate sphere, I would say. So it's similar to how Facebook began with Harvard, Ivy League, then broader universities and colleges, and then the broader public. But I would say the advantages of using this versus other, let's say, other like centralized or traditional lending solutions is going to be it's going to be the fact that it's more scalable and efficient. So I think for borrowers, what they're generally like, the first borrowers who are using the platform are first and foremost attracted by the fact that they can get financing here versus traditional lenders who will not lend to the crypto native sector yet. But secondly, it's the fact that because this infrastructure is global in nature and it's much faster than going through the traditional system, it's actually access to a really large inventory of assets and capital that they can borrow, because Maple pools can take in capital from anywhere around the world very easily, because people can access the front end and then deposit stable coins, and it only takes 15 seconds to process. So compare that with having to go through a traditional solution where it would take days to actually settle a loan transaction like that. And then the other one is it offers a kind of competitive marketplace where they can come onto the platform, they can deal with multiple pool delegates, and over time we would add more pool delegates to the platform, which creates a kind of competitive marketplace versus, say, just having to go to, if they actually want to raise debt, going to either a local bank or local investment bank to try and structure a finance product for themselves.
I see. Yeah. So you mentioned like the kind of roadmap or what you have in mind? Like first, right now, it's like market makers, later on miners, and then a bigger circle is like fintech, and then like traditional firms like corporate, right?
Yeah.
So what do you think are like some of the key milestones or series of milestones we need to hit for this kind of thing to become more realistic, like the corporate start to consider this option?
So I think sorry, could you just repeat that question?
Sure. I'm just saying, you said like at the beginning right now you're doing market making firms,
Yeah.
and then later on you want to expand it to miners and like eventually corporate or like fintech and then corporate traditional firms.
Yeah, of course.
What are the like milestones you think you need to either your firm need to hit, or the general the tech or the crypto environment to hit for this become more like a reality?
Oh yeah, of course. Yeah. So great question. So I think first and foremost, one of the major ones is going to be on-ramps. So for us to really grow, I think we've got to tap a lot of the volume coming from traditional finance. But one of the huge barriers for them to actually access the space is the availability of on-ramps to get into crypto and then to interact with protocols like Maple. So I think that's probably the first one. So on-ramps, and then custody or wallet solutions. So you have wallet solutions like Fireblocks and Copper, which are really good for institutions because they can set internal policies which manage operational security. The other one is custody solutions like Anchorage, who is one of our partners, which service institutions that can't actually hold crypto on their balance sheets yet because of mandate reasons. So I think that would be another one, is if they can just work with custody partners who can handle that for them and interact with the protocol for them. I think that would be huge, huge for growth. The second one is the actual cost of capital. So I can't service really large multi-billion-dollar institutions from the traditional corporate sphere because they have access to a lower cost of borrowing through banks or debt capital markets. And that's why we've, as a wedge, served crypto native companies first because they're profitable and so they can actually pay the higher spreads. But over time, we want to compress that cost of capital. And that one of the ways that we're going to do that is actually by trying to access traditional finance and bring them into the space because they have a lower opportunity cost of capital. So as I can do that, it'll enable me to serve a larger set of borrowing institutions. The other one is, I think that the broader space will be pushed ahead quite meaningfully as banking ecosystem support expands to support crypto, basically the crypto native spending, which is people who get paid in USDC and then want to, spend in USDC or spend their USDC and actually have it seamlessly converted to pay, let's say, pay for groceries, or to borrow and purchase a house using banking services and products that would, either settle in, allow them to use USDC savings or other stablecoin savings towards that. So I think that's actually where institutions like Celsius, for example, and BlockFi are hugely important, because as they roll out banking products that are kind of crypto native to the broader public, it enables more people to kind of remain within a crypto native ecosystem. Like myself, I get paid in US dollar stablecoins, for example. And then the fourth one would be just the Lindy effect. So I think the longer that TVL remains large and that protocols like ours have been live, we benefit from, people being able to take more comfort that there are less smart contract risks, or that smart contract risks are being managed appropriately. And so I think that helps us as well. So overall, on-ramps, cost of capital, banking ecosystem support, and then the Lindy effect.
I see. Yeah. Thank you for sharing. And also, I think part of your ecosystem, one important component is this on-chain reputation system, right?
Yeah.
Or on-chain credit score. So the question I have is, usually like decentralized identity is kind of important, right, to build this kind of on-chain reputation system and credit score system. So what do you think, like the current decentralized identity solution, what's kind of missing for a more mature credit score on-chain credit system? That's the first question. Second question is just overall for us to have a mature on-chain credit system other than decentralized identity solution. What other things you think need to be ready?
Okay, so I guess the main thrust of the question is kind of I suppose what is the state of like decentralized identity solutions, and then how does that kind of contribute to the growth of perhaps DeFi lending or participation in the space? So I would say you can broadly bucket decentralized identity and credit scoring solutions into kind of two categories. You have more of the retail facing one or retail targeted one, which would be kind of the equivalent of like a FICO score. And then you have maybe the more institutional one, which would be like a Moody's credit rating or a Fitch credit rating, for example, which would then feature in lending to really large institutions. So I think what's been lacking in actually putting these scores together and having them be meaningful contributors is there's a blend of kind of off-chain and on-chain activity that needs to be taken into account. So if I look at our borrowers, for example, like a market maker is going to be performing most of their activity on many centralized exchanges. So this would be like Binance, FTX, Kraken, Huobi, for example. Now you can't just go and read that data on chain. So that then leaves out a meaningful portion of what you would need to include in a credit score, and makes that inaccessible. So there are products like XMargin that are trying to bridge this. And I think that's a really promising solution, where they would knit together all of the data from those centralized exchanges and then allow the individual or company to choose who they share that data with. So it still gives the individual sovereignty over their credit score and what they share, which I think is really important. But I think we'll probably see a lot more of this activity migrate on chain over time, which is therefore going to provide more data points for people who are trying to build credit scores. The other one I think is KYC. And so there's a number of projects trying to do KYC in a tokenized format or in a form that's attached to a wallet or in a form that's attached to a protocol. And I think one of the big issues there is that it's like everybody needs to observe their own standards of KYC. And so it's been a huge coordination issue where you have to basically have people who observe a KYC standard, and then they are trusted enough that other people can accept that they are completing KYC according to the requirements. Now, if you had a product like a decentralized identity product where you can attest or you get a token that says that you went through that process, like I think that would be hugely beneficial to the space just because it makes the user experience that much easier. But it has been the fact that everybody takes it so seriously that they have to use different standards that's probably held that back. It's not really kind of like a risk balanced approach. But I think MetaMask Institutional is one that's trying to do, that is doing really good things there.
Yeah, we have in the accelerator, we have some startup trying to tackle like decentralized identity problem, and also some others trying to tackle the under collateralized lending. Avari being one of them actually.
Awesome.
Yeah, actually, since we touched the topic of Avari, I'm very interested and curious about the acquisition of Avari, because we had them like doing a pitch last December. It was like a month ago or so, and then like the news derived, I think was like early this week or last week, that you guys decided to acquire Avari. Now they become part of the team. What's your consideration there, and why Solana?
It's a good question. And so I'll start with the problem that we were trying to solve was we had hypothesized. So some of our borrowers had been complaining about gas costs, like it might cost them, say, $1,000 to launch a loan, right? And so we had hypothesized, well, we're playing in the institutional space. So if you're taking out a $10 million loan, then you don't really care if you pay $1,000 in transaction costs. But as we've progressed through, it's been borne out that that's not the case, that they actually very much do care. And so that was the first thing. So we therefore had a problem we needed to solve, which was we needed to provide lower transaction costs or cost of using the platform and faster speeds. So that prompted us to try and look across the set of solutions. And we looked at layer 2s, we looked at alternative layer 1s. And then as we actually canvassed our borrower base to see what the requirements of the solution would be, we could see that they had concerns around bridges. So layer 2s weren't really an option because the borrowers that we deal with don't have the operational capacity to manage bridges, and they have security concerns around locking funds or having things lost moving across bridges. That kind of ruled out the set of layer 2s. So then we looked at what alternative layer 1s could we use. Now Solana was a challenge because it's in Rust. It's a different programming language, so it requires a different set of capabilities versus something like, say, Avalanche, which is EVM compatible, and therefore we could just port things across using our existing Solidity code base. So what we looked at there was we wanted to see infrastructure support. So we wanted to see that there's things like a multi-sig wallet. There's actually not a great multi-sig wallet option yet on Solana. But Fireblock support is coming for it, and that is, one of the things that most of our institutional borrowers use. So you needed to have the picks and shovels that would actually support us rolling out a product on this chain. The next thing we needed was an ecosystem. So we actually needed sufficient size so that if we roll out a pool, we could actually see it getting to $1 billion, right? I don't want to go and launch a pool on a chain where I'm only going to be able to get 50 million in lending capital there. It's just it's not a provable market for me. So we could see that with Solana, there's actually a large degree of support. I think, a couple of months ago, it had a high of, maybe 15 billion in TVL. It's currently hovering around 8 billion TVL, but that's still quite substantial. And that's a big market that we can attack. And then you've got a DeFi ecosystem that's now quite, reasonably strong there, where we actually have the ability to, do partnerships with other DeFi protocols. We might be able to serve their DAOs as a treasury management solution. So that ecosystem richness was really important for us. And of course, the support from some of our existing partners like Alameda was a really positive incentive for us to move there as well. And then the other one is I was actually really interested in, if I wanted to make our organization more robust, it probably made the most sense to go to a chain that was actually quite different from the one that we're on, because it would require a new set of engineering capability, which we've had to build out. You can either stock that organically by just going and hiring people. You can do it inorganically through an acquisition, which is the path we opted for. And so then that gets us to what did we see in Avari? So me and my co-founder started researching moving onto other chains, or what other attractive markets would be out there. Probably around November, I was in Lisbon for the Solana Breakpoint conference, and so I met a few teams there. Then it was actually really close to Christmas. We started thinking, well, who's already kind of doing Maple on another chain? And so we got a few introductions. We met Quinn and his co-founder Jeff. We felt like they were really strong. That we got along well with them, that we shared values and alignment. And so we had a couple of conversations with them, and then we decided to, pull the trigger on an offer around, I think it was actually New Year's Day. So I was working across that weekend, and we felt strong alignment. Those guys have done really well. And so they're now part of the team. So when we launch on Solana, which we'll be aiming for in the start of March, it'll be, Maple Solana that is launched, and it will be using, Avari's code base. So they've, been sort of seamlessly integrated in as part of the team.
Nice. An interesting story is that I actually met Sid in DeFiCon. I think it's 20th.
DeFiCon in
20th or 19th of December. And then after I checked with Queen, I think around Christmas timeframe, and asked him if he need an introduction to Sid. And he said, yeah, had been introduced to Sid the day before.
Right. Yeah. Fortuitous timing. Yeah.
Very interesting. So I want to open the floor for questions, but I just have last question we collected from the audience. That's quite interesting. So it's more general question on risk management. So
Sure.
what's your thought or how Maple Finance would handle like systemic risk in a bear market where maybe the default rate might be higher due to the market condition and also the pool, right? The staking pool. If you have half the reserve or some of the reserve in Maple token, and during during bear market, the token value might drop. So
Yeah.
what if there's a situation where the staking pool cannot pay back the difference of the default?
Yeah, it's a good question. So, and I would say, I mean, we're actually kind of going through what many people would refer to as a bear market at the moment, and you can see that none of our borrowers have been even late on any payments so far. So we've had 0 late payments to date since launching in May. But for the sake of and that's because again the borrowers are mostly like market neutral trading funds. But let's say for argument's sake and for a thought experiment, let's say there's a systemic level of defaults within the pool. So the way that happens is that a borrower misses an interest payment and they miss a 5-day grace period. At that point, the delegate who's managing the pool can trigger a default and liquidation. And then what occurs then is that you size up the shortfall. So the smart contracts will calculate how much the borrower owes, which is outstanding loan balance less the proceeds of any collateral that they provided. So let's say you had a borrower who was like fully unsecured for, I don't know, $2 million. Well, what's going to happen is that the protocol is going to take funds out of the reserve, and those funds are currently comprised of the MPL token and USDC. So we put USDC in there so that we would have a volatility buffer against fluctuations in the price of the token. So it's going to take the Maple token and USDC out of that pool. It will trade the Maple token for USDC, and then it will grab the smaller of that outstanding loan amount, which was $2 million, or the balance of the reserve, and then it will apply that back into the pool to make the senior lenders whole. So if the reserve is not adequately sized to cover, let's say like 10 defaults within a pool, then that's where the lenders who are in a senior position will suffer a capital loss. And that's, you know, there is no free lunch in finance. So they are being paid the interest rate which reflects the credit risk of the borrowers. So we provide that buffer such that there is a measure of protection if there's not a systemic level of defaults within the pool. But if you have, half the pool default, then that's where you'd see that capital buffer depleted. So that's what's happening on chain. But what's happening off chain is that we also have the Cayman Foundation, which has an assignable right under the loan agreements to go and commence litigation or commence arbitration proceedings against those borrowers. So a borrower could still be taken to bankruptcy court. And all of these borrowers are generally borrowing from other platforms as well. So it would trigger cross defaults for them. So it would actually be quite adverse for any of the borrowers that we're dealing with. So that's what that would look like from an enforcement perspective.
Yeah, makes sense. Thank you for going through this thought experiment with us in this kind of extreme scenario. Hopefully it doesn't happen, the black swan event, right?
Yeah, but it's worth noting, like I would actually say it's not a market downturn that's kind of the biggest risk. It would be something like all of Binance getting shut down overnight. Like that's it's operational security risks that are actually kind of the bigger thing that I would be, worried. That's what I'm more likely to lose sleep over than a general market downturn.
Yeah, definitely. Thank you. So now we'll open the floor for questions. So I already saw some question on the chat. I think Ade, do you want to go ahead? You should be able to unmute yourself.
I'm happy. Yeah, you can unmute. I can also read your question.
Hey, Sid, can you hear me?
Yeah, I can.
Yeah, I mean, I wrote the question in the chat, but I'm also curious on top of that. I looked through your rates, and it looks like you're breaking up some of the rates that are like publicly available between like in-kind rewards and your local Maple token. So I'm actually a Maple token holder, proudly.
Yes.
And what I'm curious about is that the sweetener on that yield that you give in Maple token, is that issued when a loan or a person deposits something into these lending pools, or is it issued to like pay them back, but or is it just from the Treasury, and it's pre-issued and then distributed?
It's so I'll tackle that question first, and I'll tackle the one on collateral. So the MPL token rewards part of the liquidity mining program, which kind of bootstrapped early growth. So that's coming out of the MapleDAO Treasury. So it had an allocation of 30%, which was to go towards liquidity mining. And the way that works is it's actually done as a deposit into the pool at the start of every month that's then distributed block by block. Whereas the interest payments, which is a USDC yield, is coming as borrowers make their monthly repayments. And the borrowers will be making those on different dates throughout the month. So it can be a little bit lumpy. Whereas the MPL rewards is block by block, so it's smoothed.
Okay, gotcha. And then I guess just a quick follow up on that. You mentioned people pay monthly. So if I'm a depositor, given that the pool is big enough, is there instant redemption rights, or is there a certain lockup that you require from the depositor?
So there is a lockup. This was something we thought about because from a gamified design perspective, if you'd had the ability to go in and go out straight away, people could have front run interest payments. So you could have seen when an interest payment was coming, and then just gone like 30 days straight after that. And you would be able to then front run the next payment and then get in, collect your interest, and then get out of the pool, and you're not actually really bearing any of the credit risk. So that's why we implemented a lockup, which was 90 days for lenders. So after 90 days, you're then able to withdraw at a 10-day cooldown period, which you can trigger anytime. So it's like, after you've been in 120 days, the 90 days doesn't reset. You're still just there with a 10-day cooldown period. Having the cooldown period, aside from preventing that front running, it's actually beneficial from a security perspective, because you can't now flash loan into a pool, try and drain it, and then flash loan, and then get out within the same block transaction, which is of course what happened to it's generally where all the security issues lie with other over collateralized lending protocols, where they allow instantly getting in and out, and they might have multiple assets within a pool, which then exposes them to oracle risks.
Cool, very cool. I mean, yeah, I heard about you guys through I think a mutual friend that you might remember, Bob and Vade, and he was telling me about you guys because I'm working on an HSA that might look into stablecoin lending. So very cool stuff.
Yeah, no, appreciate it. And then your other question on the collateral side of things. So typically, like the highest we'd gone had been maybe 50% for a couple of borrowers, but just because of the unique characteristics of our borrowers, which is that they're market makers, they prize capital efficiency above all else. So they're generally going to opt for higher pricing in order to take out a lower level of collateral. So you'll see actually about it's probably like 90% of the loans on our platform at the moment are fully uncollateralized. Whereas you could see that if we were lending to a different sector, say miners, they'd be more likely to provide collateral of some kind. And so you generally see a higher average collateral level if we were, as we expand into that sector.
Oh, gotcha. Okay. Totally makes sense. So for like, I guess the base case in your borrower's perspective, they don't really have to post up collateral, but they have to be verified. They
do have to be verified, yeah. And so the decision on whether they would need to post collateral or not, it's up to a bilateral negotiation between them and the delegate. So we'd had borrowers before that might have been smaller in size. And so if they're perceived to be like riskier, then the delegate might ask for more collateral, in order to get comfortable lending, let's say like $1 million to them, maybe takes out 50 or 60% in collateral from them. So it does come back to a decision of like the credit risk and credit worthiness of the borrower. And also, like basically how much more they're willing to pay in price. Like if they really, really wanted to be sharpest on price, they might go like fully 100% collateralized in order to get, sharper pricing.
So are these delegates people you verify personally, or are they just randos on the internet?
No. Yeah. So I think it's really important for where we are as a marketplace to maintain the quality of the delegates. And, we wouldn't want a situation where you have somebody who comes on, is like kind of a, let's say like a Twitter anon, who then acts as a delegate and then like rugs people lending into the pool. So for us, that reputational element is really important. So with delegates, we look at reputation, that they have the credit or the underwriting experience to appropriately manage risk, and that they also have the relationships to bring either deal flow or to bring capital into their pools. We treat this very much kind of like a franchise model. So it's like we're playing a pretty active role in like due diligencing the delegates. But over time, we want to decentralize that process more to the point where you'd have a delegate or a proposed delegate might come on, submit a proposal, and then be like whitelisted, either by a token holder vote or the community, adding to the utility of the token there. But it's very much treated like a franchise model, right? It's like you have Subway franchises, which are on every street corner and have a very low barrier to entry. So it's a poorer quality experience, and they tend to go out of business quicker. Whereas you contrast that with like McDonald's franchises, where they have higher, more stringent criteria in terms of liquid net worth or net assets or operating experience, and they have fewer of them. So they're therefore a more sustainable, more successful business model. And that's really what we want to kind of err towards.
Gotcha. So if I'm like, let's say the Bank of Stanford, and want to be a lender in your protocol, would I be able to essentially, try to get elected as a delegate or delegator, and essentially lend my own funds, or just essentially make sure my funds are going into over collateralized pools or somewhat collateralized pools, threshold of sorts?
Yeah, you could do that. And that's a really good question, because that gets to how we want to position ourselves, which is we're more like asset light infrastructure. I don't want to have to take a position or bring my own, bring Maple's balance sheet to bear in lending. Instead, I think it's a more attractive position for us to be in, to just be infrastructure, kind of like Stripe or kind of like Shopify, as I said earlier. And then we allow talented underwriters or underwriting businesses or fixed income asset managers to come onto the platform and set up their own pool, and they can lend in the style they want. It could be to us, like if you're the Bank of Stanford, you could choose a particular subsector or region to lend to, or risk class, whether it be like the size of the counterparty, and you could apply your own underwriting standards to that. So you could say, we're only going to do over collateralized loans, or you could say, we're only going to do loans to, to SaaS companies, for example.
Gotcha. Thanks. I'll let you get to some other questions too.
No, that's great questions.
Yeah. Kara, do you want to unmute yourself?
Yeah, sure. Hi, I'm a big fan of like what you do at Maple, and couple questions. Actually, this is like probably a little bit boring topics compared to what was asked earlier, but on the KYC and AML side. So I was wondering whether you run any of more kind of in-house, like specialized KYC and AML processes that might be different from, traditional lenders.
I think it generally follows a fairly traditional approach with the KYB process. For example, like the delegates will do their own KYC. We might assist in that, and I think that's been good, because it's given us a sense of kind of the gaps in that product and the user experience. And I would say what we've been looking for and exploring now is, are there people who have productized this where we can use that service and bring it into the workflow, so that it's less of a manual process. I think the advantage of having it as a manual process is you control the user's user experience. And that means, that we can kind of make sure that there's not unnecessary delays or anything like that. But the problem is it's obviously less scalable. So, we couldn't process like 1,000 borrowers doing it that way. And so we are looking at products, be it like Securitize, be it like Spring Labs, There's a few people in the space that we're talking to, but the main thing for us is that it doesn't hurt the conversion rate, which I've been through a ton of like KYC processes myself, where I'm trying to KYC either myself or an entity, and I actually just drop out of the process because it's like, it's too hard to submit the documents. They're inflexible in the documents that are required. And so that's what we assiduously want to avoid.
Makes a lot of sense. And the follow-up question is slightly different from like the topics that we talked about, but basically like I've seen more and more DAOs with member names not disclosed, and a lot of them are on the pseudonym. And I think they are also like having a huge demands for liquidity for multiple reasons. I don't know whether Maple is ready to provide a loan to those. What's your thoughts there? Like what's going to happen potentially?
Yeah, I think DAOs are a really interesting one for us to think about. And I think, DAOs are going to be like the sovereign wealth funds of the next 5 to 10 years. Maybe it's closer to 10 years rather than 5 years. But I think ultimately, just because of the ease of raising capital and coordinating and managing capital and actually coordinating and managing membership, DAOs will naturally accrue most of the capital in the world and become kind of the largest, just the largest structure built around asset management. Like I think it's fairly inevitable. But the obvious challenge at the moment is that you have DAOs that have a number of anonymous members. You have DAOs that don't have anonymous members, and they've actually KYC'd all their members. Good examples would be the Lao and other ones coming out of kind of the Tribute DAO ecosystem. And so I think I'm very interested in, could we do a first loan to a DAO? And what I look for in potential DAO borrowers are going to be, do they actually have a business model that provides stable recurring cash flows that I can kind of predictably map out for the future, so that I know that if I lent to them, they can actually service the interest payments. And that was kind of the first missing piece. So we looked at, something like Sushi Swap might have been the first one that seemed to have recurring cash flows. But then of course you had kind of the management issues, the issues with anonymous team members. And so we couldn't really get comfortable on that one. But what I'm seeing emerge in the space now is like play to earn DAOs and guilds. And I think that's kind of interesting because it's just like they have an upfront investment in, metaverse gaming items like Axes, for example, and then they then earn a yield from lending those to in the scholarships. So I can form a view on what likely cash flows are going to be coming from that play to earn DAO. Then if I can understand who the management is and kind of get comfortable with them, that they know what they're doing, and that they're not going to like fragment and split apart over the next 12 months. And then if I can KYC them, I could probably get comfortable enough to actually lend to that DAO, because then the DAO is just the form of coordination for them. And they might have like a foundation or other kind of legal entity behind them that I could actually have sign a loan agreement.
Yeah. In that case, do you think you can get around the AML?
Well, some of those foundations, they like YGG, for example, has a foundation that has known members, that has like an office address, and therefore you would actually be able to KYC them, have them sign a legal agreement. So I could probably start there as the lower hanging fruit, and then otherwise, if you wanted to do it in a more risk-off way, I could take more collateral from them. And that's probably where I would actually take a higher level of collateralization and lending, because these DAO treasuries, they raise a bunch of capital and they've done it at a fairly high cost of capital because it's issuance of their native token or of equity in that business. And so it's more capital efficient for them to raise debt from a protocol like Maple. And so they've got these treasury tokens or other treasury resources that are actually sitting there underutilized. And it's probably a better proposition for them to use that as collateral and give our lenders like a higher level of collateral to sort of de-risk their position. That was one of the things we looked at with Sushi. Sushi was sitting on like, tens or like 100 million worth of assets. And if it wanted to borrow $20 million, well, it wasn't like it was going to spend, $40 million of its own token over the next 12 months. So they could have done like a 200% collateralization, for example. And that's probably the model that I think the earliest DAO loans will take.
Interesting. Thank you.
Sorry. It's a good question.
Yeah. Yeah, I think that's definitely like interesting, right? The DAO aspect. Like they're sitting on top of a lot of their native tokens, which is tend to be quite volatile. And then they're doing all the work, like the work group, then the budget will suffer quite a bit if the token just when go up is good, but would go down significantly, then it can't plan work around the token, right? So
well, particularly now. And so a lot of them are doing what are called Treasury diversification rounds. And that's basically where they sell their token at like, 20, 30, 40% discount to spot. And it's so they can get stable coins so they can extend their runway and kind of de-risk themselves from the volatility of their native token. But if they can actually have access to debt finance, it makes sense for them to opt for that instead. And rather than doing like a discounted sale, which can get their community offside, and it's also obviously like they're already already equity capital, I guess, or token capital is a higher cost of capital than debt. And then if you're selling it at a discount, well, it's like you're just creaming yourself, right?
Yeah, and it will be perceived very negatively within community, right? You don't believe in your own token, selling your own token.
It does, yeah.
Yeah, cool. Awesome. So I did have receive a private message from a person who had to leave the call earlier. So the question is, I think you mentioned a bit. It's like you need plan move beyond the institutional borrowers. I think you mentioned the DAO, but any other points on add there?
No, I think our natural position is more among the institutional borrower set. That said, like the platform's scalable. So, if a delegate wanted to truly set up a pool and lend to, let's say like use it as infrastructure to lend to consumers, I would say that's, way out in future. But our first position is that this is a product that's catering towards institutional borrowers. And so the natural way that I see, let's say like an end retail borrower being served would be that it's a fintech who borrows, and then the fintech is distributing, let's say smaller consumer loans or small to medium business loans. So it's probably more akin to the model adopted by Goldfinch, where they are lending to origination companies, loan origination companies. They just also happen to have picked ones in kind of emerging markets, and it's really playing to that kind of like inclusivity theme and narrative built around DeFi. But that's the way capital markets operate today, is that a lending company would take out a wholesale loan of, let's say like, 200 million or $1 billion, and then parcel that out as smaller loans through their own infrastructure. But I think our path is I actually want to go up the chain to even larger institutions, right? So it's like where I want to go, it's like I'm lending to institutions that are maybe 50 to a billion, 50 million to $1 billion in assets at present. And where I want to get to is like in 5 years, I want Tim Cook to be borrowing, a $50 billion loan through the platform, right? And I want him to not even think about calling like JP Morgan, right? Because why would you go and call your local Blockbuster branch and just look at what inventory they've got on stock when they whip out the Rolodex, when you can, access inventory from around the world and do it, kind of through a self-service kiosk effectively.
Yeah, definitely. I think when some of the infrastructure mentioned earlier become more and more mature, it's kind of a no-brainer, right?
I think there's two schools of thoughts around DeFi at the moment. There's the idea that it needs to be permissionless, which is really the decision-making mechanisms. And then there's the idea that it's actually distributed global infrastructure, for the transfer of money. And that's kind of the part that I'm really interested in. Like, yes, we can build, coordination mechanisms through the smart contracts. And like one really cool feature not bug, is the permissionless aspect of it. But I think what's really cool for capital markets is like, if you can transfer value around the world and pool it 100 times quicker, what kind of emergent properties happen for capital markets and for spurring technological development and the growth of companies.
Yeah, Adi had a question. I think Sid mentioned or explained a bit, but in case you want to go deeper. So he said, can you explain the institutional demand for these loans? Don't this market maker have tons of access to debt financing from traditional entities that are even more capital efficient?
Yeah, it's a good question. So the answer is actually no. They don't. So paradoxically, you'd think these guys make a ton of profit. Some of them make, north of 50% return on capital. What bank wouldn't be willing to lend to them? Well, banks are constrained by their own internal risk appetite setting statements. And so if you've ever worked at a bank, you know that it takes freaking years for that stuff to change. And so if I use Citadel, so let's use Citadel as an example because they're not actually a client on the platform, but Citadel is, let's say they're doing like market making and high frequency trading in traditional instruments. So they would be able to borrow at an ultra low cost of capital from banks and traditional lenders. Now, if Citadel opened up their own crypto desk, that crypto desk would be making, I guarantee you, a higher return on capital than what their traditional, ETF or stock trading business is doing. And that they would be able to kind of cross-fund that desk using their corporate credit facilities from a bank. But if you have an organization that is just a pure play crypto trading desk, they can't get that banking relationship, even though their return on equity is probably higher than what Citadel's is on an organizational framework, because Citadel's got the traditional market making activities along with the crypto desk, which is going to be the more profitable part. So that's where we're lending, is predominantly those companies that solely have the crypto desk and they don't have the traditional financial instruments trading desks. So, we've started to lend to some players and look at players that are doing both. And for them, the pitch is that this is almost like research into a newer space. So it's like, I can't offer them a product that's as cheap as what they can get off banks, but I can offer them one that's kind of faster, going to scale a lot. And for them, they view it almost as like a research and development bet in terms of like taking out a loan with us. But over time, our cost of capital will compress, and then, we'll take more market share off some of those TradFi players.
Yeah, it's top of the hour. I want to respect everyone's time, but I do have, just out of curiosity, last question. Based on what you said, like, what do you think when that become a reality, right? It's much better, like with borrowing for corporate on chain. What happened to banks, right, or traditional institutions where now they're like very inflexible, they're not agile, they will not be able to adapt to a blockchain solution?
Yeah, so I think, Mark Andreessen often talks about how there's kind of two ways to make money. There's bundling and unbundling. So I think probably what you see here is maybe the unbundling of kind of the institutional banking arms, which, historically have been part of this massive conglomerate. But you'll see, I guess what our platform offers is a way for really strong underwriting teams to go and compress the fixed cost of running a lending business, because, our infrastructure actually compresses most of the fixed cost of running a lending business and then makes it a variable cost proposition. So it's kind of like how, I guess, the most talented writers then left the New York Times because they found that they were subsidizing the worst ones, and unbundled it. And, like Ben Thompson goes and sets up Stratechery, right? So I think what you'll see is that kind of the really promising, let's say like, efficient, like high producing underwriting and structuring teams from the DCM areas of these banks will either go and set up their own teams and run their own businesses on top of Maple, or the banks the more nimble banks, which is probably going to be ones that may be smaller or more family owned or concentrated in ownership. Like I think Santander is kind of like quite fast moving. You also see some other ones like Seba Bank out of Europe, but these faster moving ones, or the ones that are positioning themselves to take advantage of tech trends, will grab a larger market share by using infrastructure like us. And then other ones will probably just like shrink a bit in size. I don't think they die. Like I think they continue. It's just they're less competitive. And the ones that are able to adapt and use new infrastructure will be similar to the ones that took advantage of e-commerce trends to grow in the, in the 90s and early 2000s.
Awesome. Thank you so much, Sid, for coming here and sharing with us your insights on DeFi lending. Thank you a lot for your time, for coming
that's all right.
such a late time, like you're in East Coast. So yeah.
No problem. Thanks for having me. Hope everyone had a good night, and it was a pleasure.
All right. Great. Thank you.
Thanks.